Getting started with investing and planning for your retirement is far simpler than it seems. And in this video, I'll walk you through exactly how to do it. We will go over how to build an investment portfolio using a straightforward approach. So simple that some even refer to it as a lazy portfolio. The first thing to understand before you start investing is that saving alone won't save you. Leaving your money sitting in a bank might feel safe, but it's actually losing value year after year. Not because you've done anything wrong, but because of one quiet but powerful force: inflation. Inflation is the silent thief that pushes prices up while your savings stay the same. It's why a pint that once costed £1 now sets you back £3. And if you're not doing anything with your money, it's quietly shrinking in real terms without you even noticing. That's where investing comes in. When you invest, your money isn't just sitting there, it's working. It becomes shares in real companies and growing economies. And if you give it time, something powerful starts to kick in: compound interest. It's not instant, but over time, it can transform your financial future. Let me explain. Compound interest is the force that makes your money earn more money. It's not a get-rich-quick scheme. It's a long-term strategy that rewards patience. The more time you give it, the more powerful it becomes. And no, it's not magic. Let me give you an example to show how time, when combined with the right strategy, becomes your greatest ally. So how do you do this without getting overwhelmed or staring at charts every day? The answer is surprisingly simple: index funds. These are funds that track a whole market index, like the S&P 500, which includes the 500 largest companies in the US. When you invest in an index fund, you're buying into all of those companies at once. No stock picking, no guessing, just broad, automatic exposure. And the best part? If a new company joins the index fund tomorrow, the fund updates automatically. You don't have to lift a finger. That's why it's called passive investing. You set it up once and the system takes care of the rest. But here's the catch. Many people still walk into their local bank, get sold a supposedly safe fund, and end up paying higher fees for something they could have built themselves for far less. Same outcome, much higher cost, and they don't even realize it. You don't need a master's degree, trading experience, or to be glued to financial news. What you do need is a simple, low-cost, diversified strategy. And most importantly, give it time. Because in investing, time is your most powerful asset. So now you know why investing makes sense. But what comes next could genuinely change the way you see the world of investing. We will see how compound interest has been the secret behind Warren Buffett becoming one of the most successful investors in history. And more importantly, you'll see how that same principle can work for your own future through a simple, well-structured portfolio. Not through rumors or from some trading guru promising overnight riches, but through real numbers, clear examples, and a portfolio that we will build step by step on screen, so you can follow along and see exactly how it works. Compound interest is easy to explain, but not always easy to spot in the short term. In the beginning, it can feel like nothing's happening. You invest, a year passes, you check your account, and you think, is that it? But stay consistent, give it time, and that's when the magic begins. In simple terms, compound interest means your gains also start to earn gains. Here's an easy example. If you invest £1,000 and earn 10%, you end up with £1,100. The following year, that 10% isn't applied to the original £1,000. It's applied to the £1,100. So you're not just earning on what you put in, but on what you've already earned. That's why it feels slow at first, but over time it snowballs. In fact, if you want to see this in real life, just look at Warren Buffett's net worth over time. The chart shows exactly how powerful compound interest can be. Warren Buffett started investing early and gradually built up his wealth over the decades. By age 50, he had around $67 million. At 60, that had grown to $3.8 billion. And by 83, he was worth over $58 billion. The key point? Most of his fortune didn't come when he was young. It came later. Not because he picked better stocks than anyone else, but because he gave compound interest time to work. His longtime business partner, Charlie Munger, puts it perfectly. The first £100,000 is the hardest. That's because in the beginning, it's all about what you put in. But once you hit what's called critical mass, your portfolio starts to grow on its own. You're no longer pushing it, it's pulling you forward. And that's why this matters. It's not about getting rich in a year, it's about building something that grows even when you're not constantly checking it. You stop chasing money and start letting it come to you. And now that we've seen how powerful compound interest can be, let's get to the part you're probably most interested in: how to actually build that portfolio from scratch. We'll look at which types of funds you can use, how to keep your approach simple, and how to set it up without getting buried in jargon or overthinking every move. This is about building a smart, hands-off investment strategy that works quietly in the background, so you can focus on life and not just the markets. The strategy we're about to explore is known as the lazy portfolio. It's ideal for those who want to invest wisely without constantly managing their investments. The beauty of this approach is in its simplicity. It uses just 3 types of ETFs, yet offers a diversified, balanced, and low-maintenance portfolio. It's perfect for long-term investors who want to grow their wealth steadily without having to follow the markets every day. The first type of ETF you'll want in your portfolio is one that tracks either your home market or a major global economy. A popular choice is the iShares Core S&P 500 UCITS ETF, which gives you exposure to the 500 largest companies in the US, including Apple, Microsoft, and Google. It's UCITS compliant, domiciled in Ireland, and automatically reinvests dividends, making it ideal for UK-based long-term investors. The second ETF should provide international exposure, so that your investment isn't reliant on just one country. Here you can look for ETFs that include Europe, Asia, emerging markets, or one that directly covers economies from around the world. There are options that exclude the United States, in case you've already covered that with the previous ETF, such as the Fidelity Emerging Markets Quality Income UCITS ETF, which invests in leading companies from emerging countries like China, Taiwan, or India. The third ETF should provide fixed income exposure, a bond fund that adds stability to your portfolio. A reliable option is the iShares Core Global Aggregate Bond UCITS ETF, which includes a range of government and corporate bonds from around the world. While bond returns tend to be lower than equities, they can help cushion your portfolio during market downturns. With these 3 ETFs, a core equity fund, a global or emerging market equity fund, and a bond fund, you've got the essentials of a diversified, balanced, and low-maintenance portfolio. To invest in them, you can use platforms such as Trading212, Freetrade, Hargreaves Lansdown, or AJ Bell. Simply open an account, deposit your investment amount, and use the search function to find the ETFs by name or ticker. When you look at the results, look at 2 things: the TER, which is the fees charged by the fund, the lower the better, and the historical performance. Of course, be aware that the past does not guarantee anything, but it helps you to understand what to expect in the long term. And let me quickly tell you one last trick to adjust the weight of each fund according to your age: the rule of 100. So how does this work? You subtract your age from 100 and the result is the percentage you should have in shares. What's left over, you put in bonds. For example, if you are 30 years old, 70% goes into shares and 30% into bonds. If you are 60 years old, 60% goes into bonds and 40% into shares. This way, you adapt your portfolio to the risk you can assume according to the time you are in. But before anything else, and this is the key, is that you have a strategy. Because leaving your money sitting still, waiting for the perfect moment, never works. Investing is not about getting the exact day right, it's about being in it long enough. And if you get it right from the start, even if it's little by little, your portfolio will do the work for you. Right, and that will be all for today. Make sure to give this video a like if you enjoyed it, subscribe to our channel, and if you want more content like this and are interested in stocks, check out our video about the companies with the greatest potential this year. Thanks for watching, and I'll see you in the next video.